Welcome everyone to our bootcamp on foundations of Forex and commodities. It is presented to you by No Academy. This is a service offered by Renaissance Media Group, a company specialized in market financial integrations for hardworking family. The purpose of this bootcamp is to help, hopefully, the novice or the new trader into Forex and commodities to understand the basics, the foundations required to trade professionally. The intent is to help participants to understand all the rules, guidelines, tools, and resources from start to finish so that at the end of that bootcamp, everyone who participated would be able to conduct trading alone. Certainly, this will not make you an expert, but our hope and dear desire is to see that you are able to be independent to the best of our abilities, so that way you can continue on with your journey to move beyond what we have taught you. So the foundations of Forex and commodities will cover two very important markets. And one of them, that is the first one, Forex market, is the most liquid market currently, and it has been so for a while. Then you have the commodities market, which has been one of the most dynamic market in terms of growth and evolution, because this market has gone through many changes and restructuring, both legally and financially, over the past 40 years, to the point that this market is probably the most active market today in terms of changes and growth. Most recently, arguably, cryptocurrency has been one of the new theme of discussions that has gone to the at the heart of commodities market, whereas many arguments are being made that cryptocurrency is commodities. However, this is an argument that is settled yet, both in court and in the public opinion as well, because of the fact that Congress has not provided up to this time clear guidance on what is considered commodities in respect with crypto, whether it is BTC or Ethereum. We are still following key cases in court that will help clarify the interpretation of existing laws until Congress has come with clear legal work frame for people to move forward to be able to clearly define crypto markets. But so far, there is very little argument as to admitting at least Bitcoin as a commodities for now. For the purpose of that general consensus, to the training, we will include BTC as a commodities, and that in respect to cryptocurrency will provide a solid foundations as well into crypto markets. In other words, while we are covering foundations of Forex and commodities, it should be understood by saying commodities, it will also include a good part of cryptocurrency markets in the form of BTC, which is anyway the first crypto and the king of all cryptos, both in terms of technology and size or market share. That said, I'd like to quickly introduce the contents of this. However, I'd like to point out for people who are watching this either live or that will be watching this over time, you will have several different ways you can continue to access these videos, either to our website at noacademy.com, or you can also check us on this channel, YouTube, at No Academy, which is our handle, which is the name, that you use as well. So you can always access these courses for free in terms of content. However, certain interactions will only be available to paid users. The contents today will involve many different parts, which will be about four main parts divided into two sections. The first part that I would like to cover now is the introduction to the bootcamp. During that time, I'm going to go over the title, disclaimer, what will be the whole entire contents of the bootcamp, the purpose of the bootcamp itself, and a special offer we have for people who have subscribed to this bootcamp to participate in the next one or upcoming one, which will be more advanced. And also we will tell you a little more about the program for today as well as an introduction. That said, I'd like to go quickly over the title to let you know that today we're going to do the introduction to Forex and Commodities Trading Foundations. This will be presented to you, to you by myself, Mr. Lee, which I will tell you a little more in a second. Before I just do that, I'd like to clear the air and provide you a disclaimer. The disclaimer is to protect ourselves and to clarify any legal aspect of that presentation, especially that we are dealing with financial markets, a heavily regulated space. The provider discussed is presented by No Academy, an online course program offered by Renaissance Media Group LLC. As such, the course contains specific training materials that should only be regarded and be construed as personal opinions of the presenters, the staff, and all teachers of the program and the Renaissance Media Group LLC. You, the participant. Before deciding to attend, each participant should review the course description, contact us for additional information if needed at noacademy.com, and discuss with their qualified advisors if needed to decide whether this course is appropriate for his or her current financial situation. Number three, some special considerations for Forex and commodities markets. On the matter of training programs related to Forex and commodities, it should be noted that any contents pertaining to trading or investment are solely provided for educational purposes. Additionally, Forex and commodities markets are regarded historically as highly volatile due to the inherent speculative nature of their underlying asset class. As such, anyone interested in investing or trading in the Forex and commodities market should be ready to lose part or everything of their investment very quickly. Lastly, but not least, we are not providing any professional advice at any capacity, but a training. To read it as it is written, we do not provide investment, financial, nor legal advice. Past performance does not guarantee future results. Now, speaking of the course itself, I'd like to go over the schedule quickly. As we start today on April 17, 2023, we'd like to clarify the date of closing, although it is on the 26th of April of 2023. We will be live 4 times. That is today, on Monday, Wednesday, and then next Monday and next Wednesday at 6 p.m. As far as the duration of the program, we start at 6 p.m. and we end at 9 p.m. This is a 3-hour session and the total is 12 hours. During that time, we will go in depth into teaching you about both Forex and commodities. And remember, by extension, we will also include cryptocurrencies. A large part of that will include cryptocurrency. Although we would like to make a quick observation that, in our opinion, the crypto markets right now is very unsettled and very dangerous in terms of volatility. Unless you have great confidence and experience, you should proceed with extra care. We will spend more time when it comes to trading skills on price action trading. The reason for it is because we believe that price action is the foundations of all trade in terms of a financial instrument. It means that every time there is a trade, there is a price movement, and the price movement will either go three ways, up, down, or sideways. And based on the position it goes, it creates either a, an opportunity to make money on the upside or the downside. Even on the sideway, if you can move even ever so slightly in millimeter micro change, you can still see a very micro or small change based on the price movement. There are several different trading styles that people use to capitalize on those price movement, and price action is a science that covers all the type of situation that you may encounter when you're analyzing a session or trading session or a market. And that also applies across all markets that are involved in the financial market categories, whether we talk about commodities, forex, including other type of markets such as where you have equity market, and debt market, where we talk about bonds, so on and so forth. They are all involving charts, and charts are a table that represent in graphical way what happens during the real time exchanges that take place in the financial market. By analyzing these tables, you are able to see how the price is moving in either directions. And based on those movements, you can analyze what happened in the future, what currently happens, and you can see them represented to you in different forms. And based on certain patterns, basing your hypothesis on the fact that humans are creatures of habit, you could predict a certain repetition or patterns that could be based on that principle to predict where the price will go next, and make your potential trade in expectation of uh, deriving a profit from that process. Or you may also use different approach, which would be more conservative, by looking at the underlying macro and microeconomics forces that are affecting a certain particular asset or instruments. Based on those macro or microeconomics event, you are able to determine whether the asset is overvalued and undervalued. And based on that, you will make the hypothesis that because the asset is undervalued, when the market goes into a correction and it affects this particular asset in such way that it helps it correct its value, it will go up because it has been undervalued. And you would place investment, wait for a long time, usually up to 10 to 20 years. That's when you do the investment approach. Then once the value reach certain level that it was supposed to reach, based on a lot of information that will provide you the current status of that asset, and its relationship to its surrounding economic events, then you will be able to determine whether there is an imbalance or balance. Based on those, you will seek to make a profit by locating undervalued assets to wait for them to fulfill their potential and make a profit. These are two general approach. It's either you're looking at the value or you're looking at the price. But this training will be limited to the first part, where you go on the hypothesis that price movement is going to follow patterns, because humans are creatures of habit, and based off that, you will study different patterns that reveal structure in collective human behavior inside of this market, to determine what traders will most likely want to do, which will definitely define how the market moves. We will for doing that, we will introduce you to major analysis tools They are grouped into categories. We will explain to you what each categories means and how you use them. But based on my experience, we've just by looking at the price action, a lot of opportunities already will be revealed to you. And if you follow patterns properly, you should be able to derive a lot of conclusions that are useful. However, because other people use technical analysis and other tools, there is something called a fulfilling prophecy phenomena, whereas if enough people are doing exactly something the same way, they tend to cause the same thing they hope to happen to actually happen. For instance, if a group of traders, enough of them at a particular time believe that the price might go up and they start buying, even if the price was not going to move either up or down, just by the behavioral reaction to that belief and this in buying these assets will actually cause the price to go up. And a lot of time, these traders make those decisions on technical analysis. So if you can analyze the same technical analysis tools that they are using, you can kind of, if you do it the right way, predict what they are trying to do or how they are reading those analysis. Then based off that, you can predict what most people who are doing that will do. And if you are right, you will be able to make good trades. But there's another way to look at it. Those technical analysis also are revealing to you patterns. And if everybody is repeating the same behavior given the same situation, it's not far-fetched to theorize that they will actually repeat the same behavioral pattern given the same situations and the same conditions or understanding. The key point is to double check whether they are actually doing that, because sometimes certain situation will instead create confusion instead of a clear pattern. Where you are in those situation, it's always best to not trade and wait. But even then, with some more advanced tool, you might be able to still get some great conclusions. Now, when it comes to trading, even if you have all the tools available, it's always best to stay with the basics and not encumber yourself with too many tools or resources, because what may happen is the reverse. Instead of getting understanding, you might actually get more confusion than understanding. And that's not what you want to happen when you do a technical analysis. You want to be able to get clarity. That's why your idea is to try to keep your process as simple as possible with as little interaction with outside agent as possible, so you can keep your mind clear. And remember, it's more about knowledge than the tools. Then that way you can always see clearer. That's what's going to help you move forward, is ability to see clear in any given situation. And that takes us to the next point that we will also cover, which is trading principles. It's a less technical aspect, but more philosophical and psychological game. This is where we go over the mentality of traders that are winning in the market as compared to those who are losing, based on historical data, based on general human psychology and social psychology. We come to some understanding, and also based on principles as well that have been established to work either personally or from a broad consensus. There have been some trading principles that have pretty much been um, in the field for a long time, and they have revealed to be useful. None of them is 100% a key to the kingdom where you have one turnkey that works. But as you develop more experience and understanding, and with time, you will begin to develop a certain sensitivity or relationship with tools, and you will be able to understand where they apply and where they are not apply. One thing you should always remember is all tools are limited to certain situations, and all principles are only true within a certain domains or range. And once you pass that range, it no longer applies. For example, if there's a market that is uptrending, meaning it's going up, there are certain principles that will do you well, certain others that will not work, as opposed to going to a downtrend, which also will work with certain other underlying psychological forces that will make traders to behave differently. You would have thought that if the price goes up a certain way and it goes down a certain way, the reverse would be equally true, meaning if people behave this way as it goes up, they will behave in the opposite way as it goes down. Unfortunately, that's not how reality works, because technically it makes sense. If it goes up and it goes down in the same manner, then it makes sense. The problem is, as it goes up in history, we have learned in psychology, not in trading or math. In psychology, we've learned that people tend to be very complacent and overconfident when prices are going up their way. But when they are going long or they are buying and the price are going down, the feeling that now takes over is not exactly confidence and complacent. It's more like fear and doubt. And with fear of that and doubt, people tend to hesitate and not make enough moves to correct it, as opposed to where it was going up. In other words, people are responding to feelings that are not necessarily reflecting reality, and out of fears, they tend to make the matter worse instead of better. So because of that imbalance between positive and negative, you do not always get a fair um, or symmetrical process, but you get something that's more like unique in each way. That means as the market is going downtrend, you need to separate whatever you've learned in terms of uptrend and start now thinking about fears and doubt, how people react to fears and doubt, which is different than when it's going up, when people are reacting to euphoria and excitement. So just keep that in mind. It's not a quick turnkey where you just put down a few trading principles and you got it and you can always make money, but it's always going to be a relationship between what you've learned and what the market is also teaching you, and how you combine that by making a good balance and paying attention. You have to pay close attention to what people are saying and doing. One way to do that is to be connected, be involved in networks where you can participate in groups or online trading communities or social network. That way you can always stay in touch with what people are saying, because they are the one who are moving the market, because they are the one who are buying or selling. And buying or selling will either move or think the price. And last and not least, there are among many tools that you can use. MT4 is one that we will use for this training. There will be other training in the future where we will speak about other tools. It's just not enough time to speak about all tools at once, but we will do our best to turn you into something of an expert level when it comes to MT4. We are not saying you will know every single thing about the MT4, but we will give you enough knowledge for you to, if you master them, for you to become an expert based on the knowledge we will provide to you with on the MT4. And then that also, as you might guess it, that will also be the main tools that we use for that training, the MT4, which I'd like to quickly give you a look on. This is my MT4, and it is set up now on Forex. I'm trading Forex right now. I'm currently trading live, and I have a position where I'm shorting the Australian dollar, and it's kind of like in a position where it's not either going up or down, and that's fine. And then we will see. We will wait, but that's something that we will discuss in more advanced study, but this will be something I bring back to you a lot of time, because the main tool that we will use is MT4. Speaking of myself, I'm Mr. Lee. I'm the CEO of Renaissance Media Group, and I am also a professional trader. A little bit more about myself. I have been involved in finance for the past 23 years. I started mostly as a mortgage originator back in 2000, when there was the mortgage bubble, or mortgage euphoria, or mortgage madness, whatever you want to call it. I was one of those young loan officers in white shirts and ties. Uh, then, as history has taught us, anything that goes beyond its means, which was the case back then, it tends to implode, and that happened in 2008. The market totally crashed with the fall of big firms like Stern, um, Bear, and other market that fell as well, including Washington Mutual, um, so on and so forth, Countrywide. These were companies uh, that went down, that showed the underlying effect of the mortgage bubble, which literally crashed the market, and we went into a major recession back in 2008, and there were a lot of bailout from the government to even save the big banks and the airline industry, so on and so forth, including the auto industry. And based off that, I have also branched out to other opportunities in the finance arena, that is the commercial market. Along that, I have also learned about business financing. And then recently, I have also included trading in my list of um, tools or outlets that have kept me busy in the financial market. That is on the technical way to understand why I'm in and how am I related to finance. Uh, in terms of trading, I trade mainly Forex and commodities, but in commodities, I really mean crypto. I do not advise new student to trade crypto now, because I'm following it closely, and I find that it's been way too many uncertainties in the market, both legally and financially, to make it a sound and safe place. However, out of my responsibility and duty as a teacher, I still I still want to teach the foundations for people who are interested in the knowledge, and for people who also can learn enough to feel confident to trade as well. While I'm saying it's dangerous, I still trade it for one reason. It's because regardless of how dangerous crypto is, it is still remaining, as of today, one of the most volatile market, which makes it also possibly one of the most lucrative market in terms of price movement and opportunity to make money based on price swing, upswing or downswing. The caution is to proceed very carefully. You could also lose your cryptos not in the market, but based on complex legal ramification, including exchange and crypto exchanges being shut down or going bankrupt and along the way. So I do trade crypto, that's for full disclosure, but at the same time, I would advise new students to start with Forex, which is more stable, without necessarily providing you financial advice, but as a teacher, that would be in my opinion, a more of a safe environment to start learning the trade and applying what you've learned in the class. In terms of other things I do in life, well, I read a lot, and I also like a few other things. One of it is going for a walk by the beach. I walk every day unless I am really busy and tired. For today, today would be an exception because I had to prepare for that bootcamp. Otherwise, I walk every day. Um, and I actually like to walk by the beach by myself and listen to, again, audiobook. So yeah, my life is kind of um, um, simple in that way when it comes to expecting me to be reading something. If you come to my desk, you will find a lot of books from left to right that I'm always reading, either about forex, commodities, or cryptos, or general business trades, or finance in general, or other things that are interesting about entrepreneurship, leadership, including leadership, and it could be anything. Um, I'm into it, and then I'm also always learning something, especially crypto. I'm always connected every day and learning in the space what's happening. That's enough about what I do on a personal level in terms of other things, which is kind of like the same thing, if I have to be honest. And of course, I have been told, and I'm not gonna confirm nor deny it, that I was and I am still a pianist, meaning I play piano. But that's kind of like a forethought. If it was to be true, I play both classical and jazz piano, but that is assuming that this was to be true. But again, that's another debate. And then I enjoy spending time with my son and my daughter, which is a very, very good blessing from heaven because that keeps me sound in life. Then I also get involved in other projects that are unrelated to this that I'm not going to really get into detail, but these are projects that are related with blockchains and humanitarian stuff, especially activism is a big deal for me. I'm also an activist, but I am a very particular. Um, um, I'm particularly sensitive to finance, so that is why I call myself an economics activist. It means my interest in seeing how we can use the science of economics to foster social change for social justice. So I strongly believe that people who are economically challenged, they could harness the power of financial markets to change their life. Uh, for the boot camps, you're going to see 4 modules. The module 1 will be the introduction to Forex and commodities, which is what we wish to do today. The second one is a module 2, which will be on Wednesday, April 19. We will talk about the price action 1 for the first time and all the basics about technical analysis that you need to do. But keep in mind that it will be very hands-on. It means that everything that I do, I will be using my screen to trade live, not really screenshot. Um, I'm not going to be using a lot of screenshot. So it will be more like a live trade during the training. So you can see in action what I talk about. That's why you learn. That's why it will always be a continuous process when it comes to forex and commodities, meaning price action will be taught to you in regards to forex and commodities. Technical analysis again will be explained to you in a way that you continue to learn more about forex and commodities. So through all 4 modules, you will see that um, forex and commodities remain the leading themes, and through those different parts, you will not be um, departing from forex and commodities on module 1, but module 2 will continue with more advanced knowledge about forex and commodities, except that they will be incorporated into principles. For example, under trading principle, as we talk about these principles, the examples again will be actual trading, live trading that we will take both in forex and commodities, including other analysis that we'll be doing. Then on module 4, we will talk about price action 2. This is where the real juice and magic happens. This is where we're going to really zero in on all the real solid foundations of price action. Then we will also use that day to talk about more advanced techniques in the MT4. For instance, here is MT4, just to give you an idea what I'm talking about. I would be on a price action class while I'm doing the training. I would be showing you these screens that I am trading, actual live trading. And then I would be looking at tools to show you all these tools that you need to know in advanced way, including advanced settings that you will be finding in very special places where you will be creating different um, tools and setups that will help you trade more and faster. Then uh, that will be in that way hands-on. As you're learning these advanced concepts, you will also be experiencing them. That's what I wanted you to realize. So it's not going to be a bunch of notes and boring texts, but it will be more like a live trading experience through the whole entire bootcamp, minus today, because today I'd like to cover some basics before we get our hands dirty. But once I'm done with those basics, we're going to light it up and move fast and get into action, meaning we will expect everybody to be coming ready with their tools to start some actions with price actions. That will end the trading for April 26th. Hey, and that also for the upcoming boot camp on May 22nd. If you've paid for this one, you get a free pass on that one. So that means a $1,500 gift from me to you for sponsoring this. And it will be the same time, Monday and Wednesday. Monday the 22nd, Wednesday the 24th of May, Monday the 29th, and Monday the 29th and Wednesday the 31st, actually. Not 31st. And yeah, and then it's 6 to 9 p.m. It's advanced. It's the same program, but it's more advanced stuff. And then we're going to do introduction to financial markets, and then we will also talk about introduction to trading. We will have small breaks in between, and then we will also talk about trading tools and introduction. Welcome back to our trading, and now we are going to talk about introduction to financial markets. First, before I get into the details of financial markets of what I would like to teach today, I'd like to go over 4 different general concepts that should help you understand how financial markets came about, although we will go more in details in a few minutes. The first thing you need to understand is values. Values is something that's important to you, that is so important to you that you feel that you could actually give something else of value to you to get that. For example, you are hungry, you need food, and you have clothes, and you have enough clothes. You feel like it would be fair for you to give some clothes to get that food, because in your mind, that food is compensating for something that is of equal value to what your clothes or dress would do for you. And that exchange started with bartering. So you have different type of values, but they are usually grouping them into two type of values. This is one they call extrinsic value and intrinsic value. Intrinsic value is things that are part of the thing that, or the subject that uses this, and extrinsic value are things surrounding this asset that also has some effect, some interaction on that thing. It could be a service, it could be an object. When it's a service, we just call it a service. And when it's a product, when it's an object, we call it a product. And the way it works is that if you remember back in prehistorical time, we men, we would use our skills and mind to fulfill our basic intrinsic needs. And generally, those basic needs are necessity for food, to eat, and for excitement, for shelter, and for health. And as we grow as species, we evolve in ways that we express those needs and how we fulfill them. We create gardening, we create fishing activities, and a lot of other activities to ensure our survival. However, oftentimes because of droughts, because of uh, lack of water, or because of other human crisis, or because of simply in the area where we are, certain things we need do not exist or are scarce, we travel different distance to find them. When we can no longer find them, we come home empty-handed. To solve this, what we created is bartering, where we find other neighboring communities that had what we didn't have, or person that had what we didn't have. We give them what we have, we think they need, and what they need will incentivize them to give us what we need. The only issue is that while this may work for a while, for as long as I have something you need and I have something that you need and you also have something I need, we should be fine. Except that in many occasions, you may have something I need and I may not have what you need, so you don't want to give me what you have because you need something in return I don't have. To solve that, humans have created mediums that most people want, and they started with stones, objects of certain unique universal values, and from there they branch out to create metals, and they would share those metals until the Egyptians discovered gold and started to trade on gold, and that becomes a commodities in that time. Until today, it's still become a centered, one of the most coveted commodities in the world. Now, because of its shyness and abilities to be transformed into objects of value, such as jewelries and other things, then gold became more like a medium of exchange. When I have something that you do not have, or you have something that I don't have, and we both need to exchange it. You don't have what I need, and I don't have what you need. We can still trade if I can give you some of my gold. Vice versa, you can give me some of your gold, and I will still look at it as something similar to what I'm giving you, as long as it's the same, and it evolved into becoming money and so on and so forth. In the process of doing that, spaces and process and mechanism has been put in place that became markets, and these markets have allowed people to transfer values. Values meaning something that's going to satisfy a needs I have, or something that's going to satisfy a need you have. And that evolves through time from informal markets to formal markets. So informal markets is something that's more like sporadic, where it's the rules of the two people trading is only the rule that matters. And usually one market that still represent that kind of informality is fair market, where you go and buy from one person, and that person is responsible for whatever he sells to you, and you're responsible to buy it, and it's not engaging the space or the location where it's being sold or what have you. Then from that, markets started to exchange assets that were transformed into temporary forms for longevity. For example, if you have foods, and foods could deteriorate with time, you could change them into gold, so you can preserve that value for a longer time. That makes that gold a commodity, because the gold will be sold at any given time for as long as someone else feel the need to trade for it, even if they don't necessarily have other intrinsic needs, just to hold it for value as well. So everybody could buy gold with other things to preserve their values. So it becomes um, a value conservation object. In the process of doing that, we create techniques and knowledge and science, and that science is called finance. Finance comes in play by providing money for or monetary value or medium for value exchange. The science of doing that, including counting it, is finance. As we use finance and then we use process and we use technical tools and resources, then we create special spaces and special system, and those systems become markets, meaning areas or environment that encourage or facilitate better trade or better exchange of value. That's a keyword. And those financial markets become markets that are specialized to deal with assets that are backed by finance, meaning by financial medium, which we will call financial instrument. And when they are regulated by government, we call them monetary instrument. That's what you need to understand. If you were to look at it from a perspective of a process, you would say values is what drove a market to evolve to now create finance as medium to preserve value for longer time and count it, to now create processes and systems that we will later create call financial markets. That said, let's now talk about financial markets in a more in-depth way. Let's talk about the introduction, the instruments, financial markets itself, and other considerations. Let's talk about this a little in more perspective. Let's define a financial market based on everything I just said. Financial markets facilitate the interaction between those who need capital with those who have capital to invest in order to allow infusion of capital into economies for creation of goods and services. Now, that's an interesting concept in terms of wording, but it doesn't help us much unless we understand what is capital and what are economies and what is investment. And there are a few words that we could highlight that needs to be clarified for this sentence to become fully clarified. The first one is we understand already kind of financial markets. That will be a process to facilitate the interaction between those who need capital. Now, stop. Let's talk about capital. Capital is the reserve of values that I can hold that someone else might need and that I can trade in the marketplace to gain certain other values that I may need in exchange. And whatever reserve that is, this is my capital as long as it is mine, it is my capital. It could be in the form of monetary assets like money. It could also be in the form of real estate or bonds or stocks or anything I hold that of value that I can actually trade or that I can use to get something else from you, more like a reserve of values that is capital. But generally speaking, in terms of investment, the most popular capital that people refer to is actually money. The reason for it is because, as you recall, I've said that money was a medium to preserve anything of value that I had. To preserve it means that it's not going to be deteriorating with time or weather conditions, and it's not going to expire over a certain period of time, because as long as that money is legal under government laws and regulations, this is something I can use anywhere that it is accepted. It's a universal asset anyone can use. So it's really awesome to be able to have money in that way, because you can carry it easily, and you can also preserve the same amount of money in form of a piece of metal or some piece of paper. So for the purpose of financial markets, when we say capital, we actually mean money. And when you need money, and I'm saying that because I want to clarify, capital is anything you can hold as value, but money again is that space where you hold all these values anyway, right? So it's like a bucket where you preserve all these values. So it's kind of like a preservation of values. So the capital is more like a package of values of something that you would call wealth, maybe, or worth, market worth, something like that. So now, when you have capital in excess, You might hold on to it. You have every right to because it's yours. Or you might want to use it to grow it as if you were growing a tree. How do you do that? You go to financial market. That's one of the way. And then you trade it and turn it into other forms that are represented usually in legal arrangement on piece of paper is called instruments. They come in all flavors and shape, but mainly we talk about stocks, bonds, derivatives, forex. Generally speaking, that's what we say. But what we do, we exchange that money for those instruments. We hold on to those instruments, and when we can trade those instruments back into the market, so that allow us to make money instead of just keep our capital fluid instead of keeping it statics, whereas it remains the same. For example, if you have 100,000 of such capital, if you don't invest it after 10 years, you're still gonna get 100,000 of that same unit with even less value with effect of inflation, because with inflation your value will go down, generally speaking. So in order for you to fight that inflation effect of holding that capital, you find a great interest in just invest it, meaning placing it in a situation where someone is going to use that money to go into other project with that money to in hope of getting in hope of getting profit, and then sharing that, making a profit and sharing it with you. So that person who needs that capital, we call them producer, meaning they're going to produce two things, either a service or goods in economies. Economies now is that whole, because we spoke about markets is what facilitate the interaction between people who have capital, but around the market is a big environment called economy. Economy is more like this big space in a country where all kind of values are exchanging hands, not only finance, not only financial instrument, but everything. And as we produce goods inside of the economy and services, that economy will either grow or get smaller. And the sum of all that productions make the economy grow, and some of those loss make it retract. Then retraction or contraction and it will express a certain loss in value of the entire stocks of that economy. So economy is more like all that interaction between all the different elements of the whole, of different parts of the whole, that's going to express whether we are producing goods and services or consuming goods and services beyond what we should need or more. That's why we talk about the gross domestic product and the balance between whatever we make and trade with other countries as well. That balance will basically express a certain reserve or total value of that economy. Now, so in order to create those goods and services, we create companies, we create commercial projects, we create something called common enterprise. Enterprise meaning a group of interests or people or resources to accomplish a certain function, to solve again some problem that's going to again satisfy values. You see, that's why when you have a business, they say value proposition is your best possible understanding of whether this market, this business will work or not, or whether there's a need for the business, there is a need for the business in that market or not, is based on its value proposition. It means whether this business can solve a problem and satisfy needs, therefore represent value in front of the people in that market, right? Now, these people, in order for them to do that, they have to pay employees, they have to buy insurance, they have to buy different other things and transfer them. Those people who are transforming products from one shape to another, or may even synthesize them to become synthetic products, whatever. Or whether they are providing a service, they still have expenses. Expenses meaning they have to use resources that will be transformed into services, and those resources, they expense them and then they transfer them into new forms. To do that, they need capital to operate, and that capital will come from the financial markets and from those people who have excess of capital. Generally speaking, it's mom and dad regular Joes that are working 9 to 5 that the system will try to get some excess of money from. The most common way is to retirement funds. And based on those arrangement and retirement funds or insurance, usually, or bank account, you can deposit your money, especially when you lock them into a CD. So the system will have a whole process in place to grab all those money and put them into the financial markets and then put them in the hands of people who need those money. We call them producers. You, on the other hand, that provides the funding because of your excess of capital, we call you investor. So if we were to review this, we would say now it's clearer. A financial market facilitates the interaction between those who need capital, meaning excess of values in reserve that they have turned into financial instrument, with those who have capital to invest. And then those who need the investment, we call them producers. They will produce goods or service in the economy in order to allow infusion of capital into economies for creation of goods and services. So now we've defined all the keywords to make that definition clearer for everyone. Now, the historical background, which I will go over in a second, I'd like to first cover the functions. As you've seen in the financial markets, we facilitate infusion of capital. So the keyword, which makes sense, is the first functions of financial market is to raise capital. And the second is transfer risk. Okay. Now, when you're in financial market, you will have the banks, the investment companies, the regulators, the broker dealers, the underwriters, which we will expand in a bit. Well, these are all people who are facilitating the transfer of that capital in different ways or shape or form. They come with different level of expertise and resources, and as they all chip in, as they all contribute, they share the risk together. For example, if the banks only know how to transfer money from point A to point B, the bank does not necessarily know how to cover the loss that can derive from theft, from accident, from errors, or fraud. Then insurance companies cover that part by sharing the risk and betting that against the risk not happening at a level they can afford by collecting money from all participants. So if one participant has the problem, they leverage that overall collection of money towards the particular problem, and they keep a difference to make a profit. Generally, that happens in the process of practicing proper math functions that allow them to mitigate their risk through different ways and forms. So that transfer of risk between the insurance and the bank, one of the insurance you might have heard of when it comes to bank is FDIC, which is a government agency, but still an insurance. It insured depositors up to $250,000. So if anything happens, the bank cannot find your money and cannot even provide a solution. FDNC will walk in and get your money back. It's really beautiful concept in a way that the bank is holding the money, but they have an extra help from the insurance who still come in and help out if the bank fails to protect your money within the means of the bank. Then you're going to have other people that are also going to be involved in the transfer of risk. You're going to have investors. You're going to have investment companies, for example. You're going to have government that will provide debts, certificates, and other things, and guarantees, so on and so forth, that provide different level of either insurance or other leverage to provide that particular bank or anybody else involved a better safety, which would never have been possible by any single part of that process. So that transfer of risk is among all people involved, including the investors themselves that provide the capital for this whole system to work. So everybody kind of takes some risk instead of one person taking all the risk. So that's where we share all the risk in, and that makes it more bearable for everyone. The second thing we want to talk about is the roles of financial markets beside the functions. The first is to provide productive saving. If you hold your money and you don't invest it in anything, you understand that you're just going to have the same amount of money, except that with inflation, it's going to lose value. That means your dollar will be less than a dollar after 10 years. By investing in the financial market, you are able to produce on top of your saving, even if it's a CD. CD is still financial markets, or anything you invest as money, part of financial markets that allows you to make a profit, that makes it productive. Instead of just holding onto it, you're making a profit or yield or return on your investment, ROI. That makes it productive instead of hiding it under your mattress, which will not be productive because you will get the same amount of money when you come back, unless somebody else saw it and steal it. That's still even less productive. Then you have assets pricing. Generally speaking, when you have fewer players, it's easy for one person to manipulate everybody else. But when you have so many players, like a market with 10 billion, 8 billion people around the world involved in it, maybe a little less, but most people are involved at some level without knowing it. Because everybody is putting some pressure in their own ways, whether the buyers that are putting buying pressures or the investors that are buying more, selling more, or causing the value to go on, or expressing more desire in the market to show the to raise the value of that asset, because the value will be defined by their ability to satisfy their intrinsic needs. By making these needs known, or by creating new needs or new markets as they call it, or by disruptive the way people satisfy their market, to educate them in new ways, which we call market disruption. Those processes affect the price on a macro level, where all parts are involved in creating different dynamics or pressure that reflect the overall sentiment of that market instead of one single person. Because the financial markets have so many people, so everybody is part of some sort of consensus that allow the price to represent more of a fair value of what the market really feels this particular asset is worth at that particular time. So this is how financial market facilitate asset pricing among the participants. Then you have the liquidity flow. Well, that's pretty logical. If you understand the first two, you will understand that because so many people are involved, money is easily dispatched among different parts, especially through the banks. And now today with fintech, you almost can do anything from your phone. That is with finance. Then the cost efficiency come from 1 to 3. You have so many people sharing the risk. You have so many people raising capital, so it makes things easier and faster and better. That also help with the cost, because so many options and so many people contributing to it, it drives the cost lower because everybody's sharing and carrying the weight. Now that you've understood how markets really help the economy and help life and makes our experience with money better, so now let's talk briefly about the historical background of markets. So speaking of informal period, these are the two major periods. Why? It's because of a very unique, interesting discovery of 1601. Before 1601, what happened? What I just described to you earlier was more like a product of sporadic arrangement. For example, a group of people in the neighborhood start creating different dynamics to deal with tradings based on their own understanding or limited view. And in that sense, you have a more like a one-on-one kind of relationship, whereas someone goes to the marketplace with food and they find one buyer who buys it, and if they don't find that buyer, they go home with no buyer. If it's not something they can transport back or that can even last longer, for example, food or cook food, you will have to leave all that in the marketplace and lose it. Or eggs, for instance. If you are traveling for a long distance, you won't even be able to travel back with that egg. You lost it. So it's so many different reasons why the one-on-one relationship was very limited in terms of trading. It not only because of the risk involved and the possibility to lose your investment, but it was also the time to get everything done, because to find your buyer, you or desired buyer at the price you want, especially the price cycle could work against you. For example, if you are in agriculture, you have seasonal um, cycle that can drive your price against your own desire or will. Whereas where you find the best buyer, you don't have the products. When you have the lowest paying buyer, that's when you have most of the product. So that makes it a more of an unproductive price cycle. Until 1601, it was more of that. Even for investment, if you were to find a very important person to invest in your business, you would have one investor. That also means that person would own you. If they don't want to invest, you would lose all other source of capital. That also make you a sort of uh, prey or a victim sometime to the capricious nature of that investor. If they don't like something, they may use that leverage of being the one source of capital to influence the project their way that may not even work for either you or them, but because of their ability to apply leverage, they could influence your project beyond reasonable limit. Then in 1601, we created the first financial market in Netherlands. What happened is that people would go to the market and being able to trade actual papers of previous contracts among other people that they would purchase, and based on those contracts they would sell it in those general markets, and those contracts will start exchanging hands, creating a trail of exchange that generated profit for people who are exchanging it by selling it for more money and hoping that the price would go up. They would sell it even for more, or if the price goes down, if they bet against it going down, they would borrow it at a higher price and buy it at the lower price and bring the paper back to the owner. Any of those arrangements started to create what we would call the formal financial market, and that happened first in Netherlands, and now today we have over 400 years of that experience and data, meaning all those market data that you've seen, all these graphs that you've seen on TV, or if you've traded also on your chart, all these information have started to exist since that day when we started to trade formally. Whereas now we no longer had to find a buyer to trade something. We could go to a market, we have 1,000 buyers on the same for the same thing. So if you are like a producer of milk and you only have milk for 2 people, then your milk could be trading in front of 4,000 people without you bringing any milk. Just a contract that you will sell that milk to this person, and that person take that contract and sell it to someone that sells it to someone else, and you made your money and everybody made money, and that kind of created a more dynamic and fair market. Of course, it didn't remain that simple. It evolved into major markets today that we have. For example, we have the NASDAQ, we have the New York Stock Exchange, we have all the different other exchange that we currently use that represents for commodities, for Forex, not exchange for Forex, but really platforms. But all these markets now exist in response to the first market we've created in 1601. Now you've heard me use the instrument a few times. I'd like to touch on that. Instruments are the kind of legal paper that we create to preserve the value under a financial agreement, meaning something that involves money. And we call them financial instruments. The first of such is securities. Securities is an investment contract, whereas one person invests XYZ amount of money into a company called a common enterprise, and that company is expected to use that money and try to derive a profit. In that process, we create a securities. So if you find anyone who makes an offer to invest in a contract, a promise of a profit that's going to be involving a business or business activities, that's going to do XYZ operation to generate that money, the first thing you should think of is securities. Securities happens where you actually, as the investor, meaning you have capital, meaning you have money preserved in terms of financial instrument, in that case, monetary value, you want to invest that money. Then you put that money, when you put that money in that contract, that person who receive that money is what we call the offering party that offers you the exchange, the securities, and that person is what we call in real economy producers, and they invest that, they take your instrument and apply it to real investment. Real investment means things in the economy that's going, activities that going to generate profits, that gonna generate goods and services for profit. Okay, and then the definition is, like I said, it's an investment contract where one person invests money and the other person receives the money, and there's an expectation the person who receives the money is going to apply it in a form of an enterprise activity to generate money somewhere, and that money somehow is going to be is going to be shared with the person who invested. When that happens, they have equities, for example, and when you have equities, you usually have two parts in the equities. You have the stocks and you have the shares. Okay, defining stocks. When a company has a need for money, or any business, and they make a public appeal to raise that money, or capital, as we like to call it, capital meaning money, and they use that capital in form of equity, it means that they're going to create a contract, a system that we call a stock, meaning that company now create a sale of contract, of investment contract, and that process of selling those little contract, that whole system called stock, is the stock of that company, meaning the company now is being sold publicly. It's almost as if the company just said, you know what, I'm tired of being myself, I'm gonna sell myself, offer myself up publicly. Anybody who wanna buy me, just buy me. That turns the company into a stock, meaning a group of values anybody can chip in, or a stock of value, a stock of assets or something, right? And that's a stock. Now, when you buy any part of that stock, you are buying a share. I can design it that way for you to understand quickly. Let me grab a pen. Let's just say I'm gonna use the metaphor of a cake, and the cake is a stock. Forgive my drawing. Let's call it a stock. I have put an 8 actually on O. Okay, your stock is the cake itself. That's what the takeaway is. Your stock is actually the cake. And then you can slice the cake into half, or into 4 parts, or even more, depending on how many people you have invited to the party, right? A birthday party. Let's just say we have uncle, grandma with husband, and 4 daughters with their husband, and so many people that came in, and they all want cake. So we're talking about 8 people. So we have to share, to cut that cake into 8 slices. Each of those slices are are shares. Share 1, share 2, share 3, and so on. So each of those slices are a share. You might get more interested in cake than someone else and you get 3 stocks. That happens. If you can afford it, then you can afford it. Then you get 3 cakes and you buy 3 cakes. That means you have 3 shares. Now, if someone else come and buy 2 more slice or get 2 more slice, they get 2 shares, and so on and so forth. Or everybody gets 1 share. If everybody gets 1 share, everybody gets the same value. But if I have 3 shares and you have 1 share, I have more share than you. For that reason, if you sell me or you give me your share, let's just say Sally does not want to eat cake anymore, and he give you his slice, and you have 3 slices. Now you have 4 slices, and Sally has 0 slice, so on and so forth. So that happens in the real market, where anybody who holds that share, they may sell it or buy more. And when they buy more, they get a higher percentage of the company. As you can see, as you get more share, you get a higher percentage of that cake. The same thing in the stock situation, where you get more share of that stock, we get a higher percentage that represents the amount of share. The only difference is sometimes it gets slightly different, where the same company can create a different offering where they create more stocks by diluting the share into more, issuing more shares that could dilute your value. So where you had a certain value, now your share is representing less value if they have more share being published. So that happens also. Back to that, we also have a difference between a public and a private company. I said that a company might offer themselves up publicly to say, I'm up for to be sold, and that's usually one way to do it. Then they create a stocks, but sometimes they don't create a stocks, meaning they do it privately. When they do it privately, they do a private offering, a private equity. When you have a public equity, it's called a stocks. When you have a private equity, it's just called a private equity. You have the same concept, the same cake concept divided by slices, except that it's not traded publicly. It means you cannot use public means to trade it, but you can still return it to the company. There are some arrangements where the company can redeem it, but you can still make claim against the company for the same amount of share that you had on that company, but it's not publicly traded. That's the main difference. Otherwise, private companies, private equities are offered for the same reason, except to individual that are presented with that offer privately, meaning there are private meetings, like I meet you in person and we discuss it. When it's public is when I use an exchange or over the counter kind of exchange, either an exchange like a regulated exchange like NASDAQ or over the counter. These are generally public space, because I'm going to be not in the public space. Here's what the difference, really the main difference is. In the public space of public situation, the share is either the exchange between the issuer and the investor, but it's also shared among the investors in the public arena. But in the private companies, it's really a one-to-one kind of relationship, where a binary relationship, where the relationship only happens between the companies and the actual investors, back and forth. The one way you know whether you have a investment that is a securities or not is by going to the Howey test. The Howey test it derives its name from a Supreme Court case that happened, whereas there was a kind of arrangement back in Florida that involved Orange and a company that issued a certain contract, and that contract, they needed to define whether the contract was there was some investment and they need to know whether that was a security or not based on money that was exchanged. And it went through different phases where at one point it was a securities and then it went to appeal and it was not a securities and it went to Supreme Court and Supreme Court said it was a part of it was a security, another part wasn't. So it's kind of like the pinnacle, the best case scenario to to illustrate how difficult legally this process that sounds so easy can be. Without getting too much into the legal mumbo jumbo of that concept, the Howey test really tried to determine the first thing whether there was a contract where someone gave money to a common enterprise. And common enterprise became at the core of the legal battle, meaning what do we call a common enterprise? What is a company that is considered a common enterprise? That became like there were many pages that were written just to define that part. Basically, it should have been just a company that does commercial activities, right? But it is just not that simple. Then the common enterprise will receive that money from an investor that has a certain expectation of this company, number one, using that not only money. In that case, it wasn't even money. In that case, it was a company using the land of these people. It means the land was considered a capital. Remember early on I mentioned that it doesn't have to be money to be a capital. In that case, the company was using the lands to grow oranges, right? But the in the litigation, the land was considered as capital at some point at a few level. So the understanding is whether that land as a capital and the company using it, whether the owner of the land expected the company to use it for some commercial activities, which the company did that though, by the way, by growing those orange, whether the person who was giving the land understood that, or whether they were just lending, whether they were just renting out their land without whatever happened to your orange. I have no idea with that. You just pay me my rent every month, sir. That could have been the end of it, but they were getting a profit. If they were expected to get a profit based on how much that company makes, then they kind of become part of a stakeholder, someone who has some expectation of a return on investment. The keyword investment. That is not, it's no longer like a lease. It's more like a partnership, right? And once you have a commercial company or commercial activities or enterprise that use capital from party A and do XYZ activities to raise profit or in expectation of raising profit or making profit and return it to that person, then you have a securities. It does pass the Howey test if that person will give you that capital, whether it's money or other form, expected to make a profit of your actions in an enterprise or common enterprise to raise profit. That expectation of profit from commercial activities is what defines the mindset of an investor. And once you have an investment contract, all the rules apply, it's a securities. Okay, the other type of securities that we have beside equities, meaning having a share in a company. Then there is also, that's why you will hear a lot the word equity market. It means market where they are trading securities that are represented in the form of shares in a company or ownership rights. And ownership rights or ownership claims are equities in that company. There is also the debt. The debt is more like a contract that's set on stone. It doesn't matter whether I make profit or not. I'm going to, no matter what, pay you a profit. That's pretty simple. And you have unsecured, that's usually rated by Moody's, and you have the secured one that are rated by the secured one that are usually backed by mortgage, but not only mortgage, but also real estate, but generally mortgage. We call them, for example, mortgage-backed securities. Besides securities, you also have commodities. Commodities are different than securities because they don't involve an investment contract where I give you money and you invest it.
and a company is going to do X, Y, Z to create goods or services to make money. That's not what happens in commodities. Commodities, I don't need a company. I just buy the thing, the asset, and the asset is supposed to grow by itself, not the company, but the asset itself. It doesn't depend on the company doing anything. So therefore, it is a securities. What I'm warning everyone was listening to that training is to be quick to feel like you are off the hook. If it doesn't fit the Howey test, it means it's not going to at least fall in the category of commodities. Because even if you're not a securities, you can still be qualified as a commodities, even if there's no common enterprise to 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 create the expectation of profit. You can still be in a situation in hot water with the law where you are still considered a commodity in a way that you are buying into something, even if it's not controlled by a centralized um, agent or company, but it's still an asset that carry over or expect to carry over certain kind of profit or returns on your investment. And then in that sense, they group them in different categories. But one easy way to group them really, it's hard commodities and soft commodities. Usually hard commodities are things that are minerals like iron, copper, these kind of stuff, metals. And then soft commodities is something you grow, like agricultural stuff. And that also includes under hard commodities, think of oil, even if oil is technically soft, but it's not something you grow. Then the other type of commodities that you will see will be forex, and forex is what we are here to do in this boot camp, forex and commodities. And forex is the kind of activities that we do that is represented in the exchange of money or currencies among nations. Then there is also futures and derivatives. We say issues, it's because it's kind of tricky. At first, futures and derivatives were supposed to be unregulated, meaning anybody could just do futures or derivatives because it was done between two people. Two separate individual would decide to make a bet that this price is going to go up and you say it's going to go down, and then we put money like a bet, just any bet. But after 2008 and the crisis, the government, including Congress, um, sat down and came up with some laws to control any swap contract and make them um, investment instrument that needs to be regulated. And while the Congress is still working out all the details up to now, but generally speaking, any swap contract that is speculating on future values is understood to be a commodities, but sometimes it's still securities. When it's so clearly a securities, certain type of them are securities. Therefore, they are regulated by SEC, which is the Security Exchange Commission. But in other cases, they are mainly regulated by CFTC, which is the Commodities Future Trading Commission. So the Congress usually encourage both SEC and CFTC to work together to sort that out for now. But generally speaking, the first word that should come out of your mind when you hear futures and derivatives, meaning betting on the future values of something, you should think of commodities first. And then if needs be, then you talk about securities. Derivatives also means a complex way of creating a contract that is trading on top of another contract to mitigate your risk in a creative way. So you remember I said the instrument is some sort of paperwork that you create to facilitate transfer of capital or money. Then derivative would create a lot of contracts that allow you to be creative about that to mitigate risk. Okay, now let's talk about financial market a little more. Let's talk about financial market by asset types or instruments. Remember I said instrument is the kind of arrangement or type, right? legal representation that's made for that kind of asset that is being traded to actually be traded. You have stock market. The stock market is a place where you trade stocks, meaning a company being offered up to be sold by shares. So that's why you have one stock per company, meaning a company will be one stock. For example, if you're buying Sony, Sony is just one stock. Or if you have you buy Apple, Apple is another stock. Or you buy uh, Facebook, it's another stock, right? So by trading those stocks in the market, you are really dealing with the stock market. Then there's the bonds market. The bond market is where you trade debts. That's something we will go deeper into at a later time because it's more complex than that. Both the stock market and the bond market will require more training in a different bootcamp. But for this bootcamp, what you need to retain is that the stock market is dealing with equity, meaning a certain ownership you have in the company. A bond market is more like a debt, not ownership. Whereas I give you XYZ amount of money, you're gonna return XYZ amount of money plus interest within precise time, or 1 year, 2 years, 5 years, or 10 years, or even 30 years. And you have both the government and private entities issuing bonds. Then the third type of instruments you would have would be the commodities that also include Forex. A lot of people don't get this right because they think that Forex is something by itself, but Forex is classified under commodities because commodities is anything that you can sell without having a company managing it for you to make money. For example, you have $10, you don't need a company to manage that $10. You can just hold it in your pocket and it is $10 no matter who holds it. That's what a commodity is. It has its own value by itself no matter who holds it. The same for gold, the same for even rice. So that makes Forex, the actually Forex exchange in itself, a commodity, not Forex. It's not currency, but Forex exchange, meaning the exchange of between two different currencies taking place among two different parties. That activity is considered a commodity. Then there is the derivative. The derivatives are contracts that are created to, like I said, to mitigate risk. And these are your main categories in terms of financial markets. And also you have the major ones. There are several ones, but the 7 major financial markets are money markets, which provide short-term debt financing and investment; derivative market, which provide instrument for management of financial risk; financial markets, which provide standardized forward contracts for trading products and at some future date; um, foreign exchange markets, which facilitate the trading of foreign exchange, meaning currency. Then number 5, you have cryptocurrency market, and we will go over most of those during the training beside spot market and interbank. Spot market is where you buy. We will talk about spot market, but because spot market really is involved in most type of other sub-markets or other markets. Then you have interbank markets, is the bank that involves banks that are lending each money to each other, or lending out money to each other, usually over time or within a week, or for emergency reasons, or because I have extra money and you need extra money and I have extra money and then I lend it to you. Usually it's based on the funds rates for the US, and the Fed funds rate is published by the Feds, and because of that reason, when the central bank meet with uh, the special committee that is designed for that, they published a Fed funds rate, and if that rate goes up, we call the government is hawkish, meaning they are aggressive, or if they lower that rate. We call the government dovish, which means they are less aggressive, like a dove. Uh, and the very fact of raising that rate or not influence markets. Then you have the LIBOR and also Euribor, which are other federal government controlled entities that determine the rate that they use to lend money to those banks, and those banks again in turn use that same consideration to either raise or lower their interest rate to their customers, which is most people in the economy. Then you have the crypto markets, and crypto markets you have a more simplified form, especially it's a new market. It's estimated it varies between 700 billion most of the time to $2 trillion. Quite frankly, it's been around $1 trillion for the past 12 months, mostly for the most time. And the spot market is where you buy something and you expect delivery of that crypto instantly. You get the money and you get the crypto back. It's just spot, and then you don't have to wait for the future delivery like a derivative. Then you have the derivatives where you have different type of contract that manage your risk, especially options and futures. In cryptos, you can do all that and even more. Then you have the NFTs. NFTs are based on non-fungible tokens, as they call them. These are typical digital assets that have intrinsic value based on the way they are designed or created that cannot be modified. And they hold their value based on interest of different parties in acquiring this as a whole. They cannot be divided. For example, someone might have an artwork, a design. You cannot split a design into two and sell it. You also can further classify financial markets by order issuing categories, meaning order issuance, meaning someone who is buying or selling some sort of financial instrument, and whoever is issuing that order to start that process, then they will be falling into one of those categories. You have the primary market. In the primary market, you're going to have an issuer, in that case, a producer who needs money for a project, a commercial project, to either create a service or a product. The first time they offer those shares or that stock, which is that company being sold in percentage, that we call shares. The first time they offer it is called IPO. And they do that either to the normal exchange or OTC, which is over the counter. The other way they do it is private placement. When I say private placement, it means I contact people individually, personally, as a company, and I offer them to buy shares, but it's not being traded publicly, whereas the parties are not selling to each other, but they are either buying from me or selling to me, the company. The secondary market is after you've traded on the primary market, you can sell that stocks or bonds or what have you among yourself. That's when you have the auction and the dealer. The auction is a process where you are selling, everybody is either offering, placing a bid or ask, meaning they are offering to sell or offering to buy, and the system would match based on order book that places a priority on first come first serve basis. A lot of time there is usually a disparity between the ask and bid, meaning the people who are buying and selling. When that happens, the market may suffer a certain losses due to that deregulation or that imbalance. To solve that, dealers, what they do, they buy the same assets in volume and they sell them in retail. So when you, instead of going to an auction to wait for someone to want to buy it, you can just buy directly to the dealer. And usually the dealer has something called a spread where the ask and the bid is different to create a spread for them. So they buy it from you cheaper and they sell it to you higher. And usually that spread is how dealers make money. Then the tertiary market is where you have a trade happening between broker dealers of large institutions and large institutions such as big investment companies like Goldman Sachs. And these guys are banks, Bank of America. And the quaternary market is where you have exchange happening between just large institutions like banks among banks and big investment firms, leaving out even the broker dealers. You can also categorize market by actors. For example, you have the investors, that is people who are investing money, like someone like you who would be investing XYZ amount of money. That means the people who have the excess capital reserve, they can invest. And then the issuers are people who are taking that money, or we can call them also producers, and they're gonna go and invest them in real and put them in real investment. So in a scenario where you are investing in the stock market or the financial markets, to be more precise, they call you a lender. You are not a lender like a bank, but you're a lender because you are giving money to someone that you expect to get back with a profit. And the issuers is someone who is issuing the offering for you to be able to place money. And that issuers, we call them borrowers, even if they are companies. So literally you are the lender or investor lending money to a company that are issuing the financial instrument called borrowers. And then you also have the intermediaries. The intermediaries are actors and entities that are going to be involved in this process between the investors and the issuers to facilitate the exchange. First, we have the exchanges, and those exchanges can be stock exchange, they can be commodities exchange, they can be a forex exchange, where the forex exchange itself, it doesn't involve a platform but a broker. The broker really use intermediaries like banks to facilitate the transaction. To the exception of that, all the other ones have their own formal exchange beside the forex. Forex, that exchange is divided, that responsibility is spread across brokers. Then you have dealer brokers. The dealer brokers are people who are buying in volumes and are also brokering them to their clients, which makes their position kind of unique in terms of conflict of interest, because they are the ones selling and they are the one representing you to buy it. So they have to disclose that to you and explain that sometimes they may not represent your best interest, and you have to understand the risk involved in dealing with dealer brokers that way. Then there are the insurers who are helping carry the weight. The underwriters are the people who prepare the investment to allow people to invest, meaning they decide to write every single part of the situation where there is an offering for public interest, and they are the one who are also going to guarantee a certain amount to be sold. And these underwriters, they are usually big bank like JP Morgan, and usually those banks also play the roles of underwriters, and as underwriters they guarantee a certain um, um, clarity or a certain accuracy in the value that they present to the market. Meaning, instead of you selling the the stocks and determine how much you think it's worth arbitrarily, the market creates the underwriters to be a third party to say how much the stock should be worth, usually during the initial uh, price offering. So it means that you don't get to say that. The underwriters get to say, oh, okay, there's a stock, a new stock, and we think based on a lot of parameters we've reviewed, including financial statements, including projection for future market integrations, we think that the stock should be worth XYZ amount of money. Since we are doing a certain amount of shares, divided that stocks by the amount of share. Each share should be worth XYZ amount of money. I'll give you a clear example. Let's just, for example, a company think that an underwriter think that your stocks is worth $2 million, for example, and you want to issue 1 million share. So by issuing 1 million share, what you're saying that is that each share is worth $2 because you have 1 million share times $2 will be $2 million, which is the value of your stock. Stock meaning your entire portfolio as a company, and that is being offered to in auction for people to buy. So you become a stock, and the stock is $2 million, and people are buying a part of that stock as shares. And the underwriters define what that value is divided by amount of shares. And once that happens after the initial offering, then it can become any value in the secondary market. That is only for the primary market. Advisors, fund managers are people who are sitting by the sideline to offer all kind of opinions and ideas on how they think you should do business as an investor. And then you also have fund managers who also do the same thing for more than one investor, pulling money together in an investment pool, generally speaking. Then you have the financial institutions that also includes investment companies and the banks. These are the major drivers of the financial markets when it comes to driving money from A to Z. Then you have the regulators, the people in suits, dark suits and dark sunglasses that you really don't like to come and ask you questions, because sometimes it could also mean bigger problem, including stuff that may be criminally related. We don't hope anybody get involved in things like that. But regulators are there to kind of like control all the parties to make sure that they follow the law and that everybody is being treated fairly. That's another way to look at the financial market and as well, which is by the offerings of the issuers. Remember, I mentioned issuers are people who are issuing a certain type of investment opportunities, whether it's a stock or what have you, and they make different offerings. The first offering is they make offerings like a stocks, and as they make offering as a stocks, you have equities that you're going to have in that company. Then also they can offer bonds. Bonds mean a debt, meaning there's no ownership to their company, but only right to the contract where you have a certain amount of money involved that you can get back. So that's another way. And then you also can organize it by market orders. Then you have first market, the type of orders you get usually are divided into two major ones. You have the market order and you have the limit order. The market order is where you buy whatever you want to buy, whatever the price is at that time, you will pay that price. Limit order is a certain amount of money you are willing to pay or sell it for before you exit or enter that position. A stop order is how far are you willing to go beyond what you were thinking or away from what you have in mind. It's more like what's your margin of error? What's the maximum margin of error you'd like to maintain? And your stop will define that. And when it reaches that, usually what happens if you are inside of a position, it takes you out. But some other time it takes you in as well, depending on how you set it up. But what it means literally is that you are deciding how much more apart from what you have in mind you want to go. Some other considerations for my financial market quickly. The first one is to think of market, always think of market as cycles, and always try to remember what cycles you're in. Usually you will have two cycles. One is a bull and the other one is bear. When it's a bull, people are buying. When it's a bear, people are selling. Then you also want to consider market psychology and trends, meaning what's going on in the people's mind in any given time. Usually that will drive their behavior into either buying or selling. And based on that process of buying or selling that is maintained, you will have a trend. The trend will either go up or down. When it's going up, we talk about uptrend. When it goes down, we talk about downtrend. Value and price. The value is what this asset can do to satisfy a certain need in a particular area, what we call market. And that value is defined by the ability for this asset to resolve that issue or satisfy that need. And the more you can satisfy needs and to more people that are interested in what you do, the higher is your value. And the less you can satisfy or respond to those needs, the less is your value, including the more favorable your macroeconomics are agreeing with you. For example, saying that you are the only or the best offer, or you have a price people can buy for based on the economic condition, meaning the purchasing power of the people in that market would define that, okay, you're offering it at a price that people will actually want to pay, or in condition and places you want people want to pay based on sentiments or prevailing or the prevailing aspect. Those parts will define the value and price of the value of the asset. The price, on the other hand, is not defined by ability to solve any problems or satisfy needs, but the price usually is defined by the excitement for people to buy it in an instant. In the moment, they might want to buy it or sell it based on sentiment, not based on what it can do for consumers. So it doesn't matter what they can do for consumers. It's a matter of how I feel about it. What about the sentiment of the moment? That drives the price up and down. And sentiment can be really illogical. And because of that reason, it makes it unpredictable. And that makes all the fun of the process. The other things you want to keep in mind is that beside the price and values, there are also a group of prices, and then when we put them together we get an average, and that average we call them indexes. You will find all kind of indexes in all markets, but indexes are there to give you an indication of what the average price across all similar assets, or in terms of maybe categories, or in terms of type, or in terms of industry, or in terms of size. So they group them based on different measures. Once they group them, they give you that average, and that average is our index. And the index will allow you to kind of gauge your price a bit by comparing your index to what the price is trending for your particular asset, whether that asset is off or of trading along with the index. That also will matter to you. And sometimes you want it to be the opposite based on what the situation is. We will run in some of those examples for you to understand. Then there are the indicators. We have economic indicators that are either leading or lagging, and we will explain those more. But basically what it means is that certain information will give you some idea of what will happen next, and some others will give you a reading of what just happened before. And of both, you will really prefer to deal with the one that are leading indicators, because they are leading you to see what's going to happen next so you can make money. The lagging indicators told you probably money you didn't make, you just missed. So you really want the one that's telling you what's going to happen instead of telling you what just happened, instead of the one that tells you what just happened before. Then you have the exchanges. The exchanges are places where you're going to exchange money and what have you. Then the last part is money and tokens. You want to keep that in mind for future